finally, with a small delay, we are starting our session. This session is going to be especially relevant because we have our colleagues from Prague and Warsaw. This in itself is quite unusual for economic debates in Russia. We are quite inertial. We usually compare ourselves and speak to people from BRICS countries located so far away. But the state of the Russian market is very much closer to the state of our neighbors' markets than the markets that we usually speak about. Against Wall Street, we look like babies if we are compared to stock exchanges in Warsaw and in Prague. There are some very real things we can learn and some very valid experience we can share. So I would invite the panelists to speak about the state of stock markets. The statistics we're getting do not show very well where things are moving. I would like to now give the floor to Peter Koblik of Prague Stock Exchange.
Thank you very much. Firstly, I apologize myself that I'll gonna speak English rather than Russian. I somehow didn't use it for 20 years, so I forget almost everything I've been able to learn in past. However, I'm representing here today the CSEC group, which is the Central European Stock Exchange Group, representing Prague Stock Exchange, Wiener Börse, Budapest Stock Exchange, and Ljubljana Stock Exchange, and also the Power Exchange Central Europe. I have a pleasure to be a joint CEO of the group, and also I'm of course the chairman of Prague Stock Exchange, and actually also in Ljubljana. Our group, as I already said, represents 4 securities markets in Central Europe, 2 securities derivatives markets, 2 commodities derivative markets, with a special focus on electricity, 3 CCPs, and 1 CSD. The creation of this group was quite a long story. However, it gained a momentum in 2007, where shareholders of Wiener Börse has been able to purchase the stocks of Budapest Stock Exchange and Prague Stock Exchange, and 2 years after we created this holding company of the 4 Central European, Eastern European markets. I was asked, a description of what we see in the recent days on our markets. I would say we see, or every market, that the markets are not in a perfect shape, especially in Europe. We are clearly, as the securities markets, victims of 2 major factors. The first factor is definitely the crisis on the liquidity on the European equity markets caused by the macroeconomic and debt crisis in Europe. And second thing, there is very big influence of coming regulation from EU to the securities markets in Europe. Fact is that it's looking like the smaller the market is, the more impact have these unfortunate factors. If I shortly touch the debt crisis and the situation, how we see it from our region with the investment into the equity markets in our region, we see many investors not leaving the region, but basically not trading the region, keeping their investments as they have them. and don't increase the investment, not trading so much. I would say it's pretty natural. Most of the investors into our markets are foreign companies, foreign asset managers, mainly pension funds from Anglo-Saxon world. And being in their shoes, looking to Europe, I would not consider it a very stable macroeconomic environment. That's for sure. We are constantly hearing about new skeletons are coming from the boxes in Europe, and obviously the investors are tired of that, and they would like to see a light on the end of the tunnel, which we hope it's becoming closer and closer, that all the things which have to be solved in Europe will be solved very soon, and the investors will return to the market with their activity. The other factor pressing our volumes is definitely the EU regulation. I'm relatively constant and outspoken critic of the European regulations like MiFID, and also some other regulations like CSDR or EMIR, definitely FTT, and the other new things which are coming from Brussels. Definitely MiFID especially brought liquidity from the regulated markets in Central and Eastern Europe to the OTC space, which had a very negative effect on the transparency. The usual argument of the MiFID was that Brussels want to create a little bit more competition between the exchanges and multilateral trading facilities, which actually didn't happen. A part of the very, very few huge European blue chips in our markets, the effect were that the trading moved to the OTC world. Where maybe 10-20% of the securities were traded over the phone prior to the MiFID. Now we are in a situation where now some of our markets, over 50% of the trading is happening in a dark environment, if you want. Some very usual in London over the phone. Of course, we have to, as a group, react on this situation. Obviously, we had two possibilities, on two reactions. The first reaction was we were diversifying our business into the new areas and to the new product streams. I would especially mention the commodities. We are now trading electricity in Czech, Austria, Slovakia, and in Hungary. Very soon we're going to start to trade gas on these markets. We are now trading within our group Austrian gas. So that's definitely a part of the markets where we see some interesting growth to be coming. We are also definitely trying to diversify ourselves to the post-trading environment. However, I think the major reason why I'm sitting here and what should be the topic of today's talk is possibility of the integrating securities market. Frankly, we are in front of this quite important question, or in front of integrating possibly the markets in CE already for the last 3 years. The good question is to say what it is actually means, to integrate securities market, because you see several aspects of the integration. You see definitely an IT aspect, an IT integration. You see definitely a legal aspect of that, and you see definitely and post-trading aspect. Over the first hurdle, we are almost successfully over in a CISA group. We were implementing one IT system, which is etc. system from Deutsche Börse, over 3 out of our 4 securities markets which we are operating. etc. system is successfully running in Vienna, Ljubljana, and Prague, and will be rolled out later on this year in Budapest. So This is surprisingly one of the easiest part when you are talking about the market integration and the market mergers. Much more difficult is when you look at the legal side, because there, although you are in one European legal space, if you want, nobody ever before tried to make a cross-border exchange merger. Nobody even thought about having one legal body with multiple exchange licenses in different countries. So it is relatively complex, and the things we are looking at are surprising us almost every day. We are trying to make a little progress in the topics like cross membership, cross listings, and another thing. You know, that there is definitely a set of a common securities law in the European Union. However, it is that there is in every country different securities regulator with much different opinions on the same questions, actually. There is a mechanism in Europe how we can streamline these different opinions, but it takes enormous amount of the time. So the legal integration, especially with respect to the licenses and regulation, is really a tough job to do, which is standing in front of us. And probably the most difficult part of that, any integration projects, is a post-trading. We were sooner or later realized sooner or later that one of the key factors when you present yourself towards your stakeholders, towards the traders and the issuers as a single marketplace is lying in a post-trade infrastructure harmonization. It is a very difficult task, given that basically in every country there is a different model of ownership of the post-trading infrastructure. We have the model of the completely private ownership, basically physical person ownership in Slovenia. We have the model of the banking ownership in Austria. We have a vertical silo in Czech Republic, and we have the joint ownership of ourselves as the majority of the government or of the central bank in Hungary. It is extremely difficult and extremely demanding try to find out any kind of common post-trading infrastructure, but we will definitely very hard try to do so, and we hope we're going to succeed. And I would probably touch one last topic, and I believe my colleague from Poland will also touch it very, very shortly. There are, according to the press releases last 14 days, some very initial thoughts of having a discussion between CISA Group and Warsaw Stock Exchange of doing any common project which will serve the markets in our region. We are in a phases of analyzing the situation, and that's about it. What we can say about this right now. Thank you.
Спасибо, Питер. И чтобы сразу продолжить тему этих...
Thank you, Peter. To follow up on this, I would like to give the floor to Robert Kwiatkowski, Vice President of Warsaw Stock Exchange.
Все будут продолжать презентацию на английском языке. Я так думаю, что...
I know that other presenters, other panelists are going to speak English, but I realized that Russian language is worth studying. That happened in New York. A woman came up to me at a metro station in Brooklyn, and she asked me about something in Russian. I took Russian classes in school, so I thought for a while and then I answered, and she said, "You must be Polish." I said, "How did you know?" She said, "Because you are Polish and you speak Russian as if you have a toothache." So that was a moment when I realized that I had to do better in my Russian. So now I would like to use this opportunity and offer you my PowerPoint presentation. Can I have the first slide, please? I'm going to show you a few charts and give you my comments regarding the state of things at Warsaw Stock Exchange. I will then tell you about Central and Eastern Europe, but let us now look at this chart. It shows capitalization of domestic companies. Warsaw is now at 36% of companies' capitalization. Those are companies traded in Warsaw Stock Exchange versus GDP. Certainly, we still have a long way to go to be where New York Stock Exchange is and a few other exchanges like Luxembourg Stock Exchange. Turnover ratio, that's the percentage of capitalization on a monthly basis. You can see that this ratio is higher than in quite a number of countries. This is Warsaw Stock Exchange's position in Europe. The value of companies traded at our exchange is more than 130 billion euros. That is what those companies are worth. If you look at the bottom part of this chart, you can see over the last 5 years what the turnover was. That is inclusive of Vienna, Budapest, and several other exchanges. Look at 2011. This was a very interesting year. What happened were several interesting things. 2012 is a 30% decline in turnover. In terms of domestic market capitalization, $631, that is the capitalization of MASEX and RTS companies. You can see the levels of other exchanges. Below this, you can see the value of equity trading sessions. You can see that the positions of Turkish Stock Exchange is very good. They are in a very good shape. We are saying that we are willing to work in different geographies, but we made most money in Turkey and in Russia. Let us now throw a look at the situation with startups. New companies mean new business. If we have no new companies, investors have no opportunities to invest in new projects. That could be the end of a stock exchange. If we look at what happened in 2012 and in the first quarter of 2013, you can see that we work very actively. There are different transactions. There are several privatization deals. The most successful transaction we saw last year was a transaction by one private bank in Poland. This bank opened 5 or 6 years ago. Now it launched a 500 million euro transaction. We have new emerging businesses. We have new emerging transactions, and this means that the market is developing. There are new companies, there are new investors. This means new opportunities, new customers. Today in Poland, 48% of turnover that we see are transactions by foreign stakeholders. International stakeholders are very important for us. we have quite a bit of local capital in Poland as well. We have recently had a pension reform. There are several very important investors, pension funds, which are prepared to invest in our economy. These people work actively in the Polish market. In Poland, many individual citizens play in capital markets. Maybe we don't have enough casinos, so people want to play in the capital markets. They will invest in different facilities. Now let us talk about integration. Here you can see the share of foreign investors in our turnover. There are quite a lot of American and British investors. What is important is that 6% of turnover come from Czech investors. There are several companies which are listed in our stock exchange, and there are quite a few investors from Czech Republic. We want to do more with them. In the next chart, I have some information about something that happened last week. Last week we launched a new trading platform known as UTP. We are using the same system as they use in Paris Stock Exchange. This is a very powerful platform. It offers a lot of functionality, and it's a big step forward. This is a very high level for us and for our investors. In the next chart, you can see development of some of our indices. This is information over 3 years' time, including the beginning of this year. You can see the number of transactions. You can see that this number is growing. This means that we have a good beginning of the year. It remains to be seen what the rest of the year is like, but I don't think it's going to be bad. The new IT platform is going to be very helpful in this too. This brings my presentation to the end. I'm out of charts. Thank you very much for your attention. Robert, thanks a lot for your presentation. I have not noticed any strong accent. You don't sound like you have a toothache at all. In conclusion, I would now like to give the floor to the representative of a Moscow Stock Exchange. We have had a replacement. We have Pavel Popov. Of Moscow Stock Exchange. Good afternoon, ladies and gentlemen. Let me start by telling you about our stock exchange. We feel that we are doing fine. In February of this year, Moscow Stock Exchange has started trading. This was after the merger between MySex and RTS. We had an IPO, which was the biggest IPO, and we issued local shares. This was a very important transaction for us, and it opens new horizons. It opens a new era in the business of our organization. We have been able to sell at 55 rubles per share. This was the lower side of the band. Our strategic goal was to attract a broad range of investors, including international investors. So the shareholders made this decision to go at this price. We made offerings to over 1,000 investors. About 70 of them were institutional international investors. So we decided to go for 900 investors who acquired our shares. This provided us with very good liquidity, and we are now one of the best traded securities in the market. Let me tell you about the structure of investor base at Moscow Stock Exchange. As you can see on the left-hand side, we have quite a variety. Up to 20% of all trades are linked to individual citizens. We have about 40% of international investors, and their share is growing. We have quite a lot of infrastructure changes, and the remaining 30% are institutional investors. Now let us look at domestic investors. There are index funds, open-end and interval funds. There's insurance reserves and pension funds. Today we go through liberalization in the way pension funds can use their money, and we expect the number of pension fund customers to grow in the years to come. We can look at the investor structures, and it's obvious that international investors are quite willing to buy Russian local shares. Let us now look at a number of projects of key importance. One of the things that we heard from international investors was that our settlement system was not convenient. Everybody was used to T+ system. On March 25, Moscow Stock Exchange started using T+2 system, which most people are comfortable with. We have launched 15 most liquid stocks and sovereign bonds in T+2 mode. We are going to increase the number of securities up to 50. People can continue to use T0 as they used to historically. That is one option. By July 1, we are going to close T0 mode, and we are going to cover more than 50 securities with T+ protocol. The pledges that have to be provided by the stakeholders to work in the new mode is in line with the international practices. You can see that it varies between 12 and 20%, roughly. Another important change, it is important for American pension funds. This is a lack of central depository service, which was our problem until recently. On January 1, 2012, a law on central depository was passed. It took a while to generate bylaws, and now the depository works. It is fully operational. International custodian associations have already recognized our depository to be sufficient in the way it protects investors' rights. We are compliant with F7 regulation, and all the investors that have been buying Russian depository receipts and could not invest in local stocks now have this opportunity. This is what we had for an account structure before CSD, when international stakeholders could have accounts at registrars or in one of the depositories. After the law, everything stays within the central depository, which performs final settlement and creates records on the securities owners. These changes have significantly improved the level of our attractiveness. International settlement systems, Euroclear and Clearstream, now have access to government bonds. The growth of foreign funds is quite significant due to secondary trades. These are some of the key projects that we've been involved in. Now I think it's time to take questions. I'm sorry I called you Moscow Stock Exchange. Thank you very much. Thank you for your inputs. We have heard from representatives of 3 venues, and a few questions that came to my mind have been already answered. Our colleagues have made references to pension funds as sources of investment growth in the market. For a long time, we had a pension system which did not produce any opportunities for investments. It did not provide good pensions either. You said that with liberalization, you hope to see a greater inflow from pension funds. How scalable this process do you think may be? The pessimism that we have seen in the market, could it negatively impact on this inflow of funds?
Well, in actual fact, there have been quite a few changes that have occurred and are going to take place. The first thing that is happening is a broad discussion of Decision 379, which tied the hands of the pension fund with regard to investment into stocks. And actually, not government fund pension funds were to show zero or positive return, which cuts off the stock market. And hopefully this. Can you tell us the gist of the forthcoming change? The gist of the forthcoming change is lack of this requirement for loss-free operation. So stocks can be included, and also participation at the initial public offering stage of pension money, because pension money is only available and accessible to A1, A2 companies. Listing requirements are such that at the time of offering, the company cannot get a top level of listing. And after listing is reformed, we expected in the third quarter. So securities pension funds can be participating in this at the offering stage. Another interesting novelty is National Welfare Fund money. We expect some serious inflow. About 30% of that money will be available in the near future, in the forthcoming years, available to the stock market, which will create a sizable inflow, which will cover privatization deals planned and private companies deals that will enter this market. My question is to all the 3 representatives of the 3 Bursa, 3 stock markets. if each of you could tell us the number of securities and blue chips out of them. In Russia, 500 securities are listed. Blue chips, again, it's not there's no strict definition. 25-30% probably in Russia are classified as Peter, with you.
Like Austria, Budapest, Hungary, and Slovenia, we are trading 300 plus securities. Frankly, the blue chips, which are investable by international investors, are probably around 20 to 30 stocks. Of that, the rest is usually smaller companies with relatively small free float and small market cap. However, interesting for local investors, maybe.
А что касается Варшавской фондовой биржи, у нас тоже есть 20 компаний самых...
We also have companies which are included in the special top 20 list. 75% of our turnover are for these 20 companies. And one of these 20 companies is a foreign company, and it's a Ukrainian company. It's a Ukrainian agricultural company, Kernel, which is registered in Luxembourg. And also shows that a company from Ukraine has achieved such a high level, which is listed in the main index of the Warsaw Stock Exchange. We have 70 to 80 blue chips for the entire region. Okay. I want to give the floor to those who represent investment. Oleg Shvirkov, I want to precisely formulate your position. Let me introduce myself. Director from Deloitte CIS. My slides. While the presentation is being opened, it would be fair to say that some of the ideas I want to share do not concern my position in Deloitte CIS, but what I did for the OECD seminar last year, for which I prepared a report It's a publicly available report. It's in the OECD website in terms of exchange management and corporate governance. I will start by showing the general investment picture in terms of equity market. Some of the people present will not find new things, but I will have to quote this because they are very important in the context of this conference, and also because there are some overseas participants for which this may be new. The first chart, that's the net capital import, which is provided by the Central Bank of Russia, 2002-2011. That's exactly the chart and numbers which are used to illustrate the capital flight. This was negative the entire crisis and post-crisis period, 80 billion outflow in 2011, 2012, they're more or less same. They are not in this chart yet. This serves to illustrate the fact that the capital does not feel comfortable in Russia, otherwise we would not see this picture for several years now. Again, it's a tricky thing and a tricky indicator. If we convert rubles into euros and deposit it with the Russian bank, they are included in this capital outflow. I think the more direct evidence is shown on the left-hand low chart, which is a portfolio equity inflow, which is more precisely illustrating what is happening. This compares it with other BRIC countries. All of these are emerging economies. Three of them are comparable in size. Chinese economy is 3 times larger than Russia or India or Brazil. This shows you dynamic from 2003. Russia has always been lagging behind the other BRIC countries in attracting portfolio investors. With regard to direct investment, it's better for Russia, since large investors involved in direct investment are more in a position to protect their rights, being in a direct dialogue with the authorities, with influential groups in the Russian economy. This does not apply to portfolio investors. Portfolio investors have the level of protection which is enjoyed by everybody else in the market. Again, it's indicative. During the recovery after the crisis, all the 3 countries, BRIC countries except Russia, increased the portfolio inflow, not Russia. After 2010, we see a net outflow of portfolio equity. That's the World Bank data. For 2011, we do not expect last year to be better than 2011. The third chart, and I want to thank Anton Malikov, head of the Sberbank CIB, who made it possible for me to use this chart. Well, this is price earnings comparison for MSCI emerging markets and MSCI index for Russia. That's a very simple comparison. Russia has its short history of existence, has its ups and downs for the entire period except a brief period in 2006. The average price and the valuation was lower for Russia than it PE for emerging markets. Again, this is compared with emerging markets. The average lagging behind is 37 to 38%. Maximum is 80% behind. In 2006, there was a brief period where Russia was 6% ahead. But it was very temporary. If you look at the right-hand side of the chart, the delta is not decreasing but increasing. The gap is increasing. The more recent data from Credit Suisse, depending on what sample you're using, they give you the average value for price earnings 5.3, 16 point something India, 12.8 for Brazil, and 10 for China. And this chart shows, again, depending upon the sample that you're using, of course, this will give you a greater lower figure. The greater the sample, the more there will be larger companies which are valued, have low valuations in the world market. If you take a larger number of companies, then they will have a higher number. But even with a larger market sample, we had 135 companies, then price earnings to earnings was 7 to 8, which is still lower than China and 2 times less than developed markets. That's the reality of today. This is a big negative for the Russian financial markets and the economy at large. We would like to look into the reasons for that. To separate political risks components, corporate governance components is not easy. To using valid empirical methods, but investors were surveyed aimed at understanding what makes international fund managers uncomfortable about Russia. And this next slide shows the results of this survey carried out by the Royal Bank of Scotland end of 2009. That's the most recent data I could get hold of. One can't expect that anything has changed seriously since that time. Portfolio managers were sent questionnaires about the reasons not to invest in Russia. Again, they could mark more than one reason, so does not add up to 100. The predictable answer is volatility of the entire economy linked to the oil price, lack of macroeconomic diversification, which cannot be resolved by diversifying the portfolio. The second answer is government and corporate governance, which are ahead of government control. It's important because macroeconomic diversification is a given with which you can deal on a long-term basis and a challenge for the government as part of their macroeconomic policy. With corporate governance, one can do something within specific companies at the trading platforms and by regulators with regard to public companies. And my last substantive slide. This information is correlated with the report that I prepared for the OECD that I mentioned in the very beginning. The question is this: what can an exchange do to improve corporate governance standards of the issuers listed in that exchange? And how does corporate governance policy affect the competitiveness of the exchange in the capital markets, given stiffer competition? The competition between the exchanges and alternative platforms is not something new. Economic history knows about the competition between 100 exchanges in the early 20th century, where the New York Stock Exchange was the winner, which was traditionally behind stock trading, behind the Boston Exchange. But the New York Stock Exchange was the winner also because everybody knew about its principled stand to protect the investors. There were no generally accepted rules of transparency, accountancy standards, and the stock exchange would dictate what standards investors should go by. There was a 1928 decision of the New York Stock Exchange not to admit companies that had one stock, one vote principle, which existed until the end of 1980s. To perform like New York Stock Exchange, or to have an approach that the more liberal we are in accessing issues, the better we perform. There are two positions. One is the OSCO voice that there's a danger of the race to the bottom, that the competition between exchanges may lead to a competitive reduction of lowering of standards. This, the second position by World Federation of Exchanges, they claim that the self-organization and competition of exchanges, competition will drive in the opposite direction. There will be a competitive increase in enhancement of standards. Stock exchanges will compete for investors through more effective mechanisms for protection of investors' rights. There have been quite a few studies on how Oxbane-Oxley Act affected the attractiveness, and there were claims that Americans are losing to London Stock Exchange. There's one academic study of Deutsch and co-authors, so they have a different point of view, opposite point of view. The conclusion is that no exchange benefited from poor investor protection and low government standards. In terms of long term, those financial markets that protect investors' rights, this is their edge. In the emerging markets, the exchanges which are in a disadvantaged position with regard to Anglo-Saxon markets, there is a niche for them as well. New York regulators and exchanges and British and other European exchanges don't have the goal or don't have the possibility to compensate for the deficiency of legal regulation that exists in other countries. SSC does not have the task of targeted compensation of lack of investor protection rights in Brazil. And Novo Mercado project demonstrated, which is a major success story from emerging economies, which sustained its position and became a leading exchange by effective mechanism of corporate governance for the premium segment. We welcome the attention given by the Moscow Exchange to these issues. We work with their own stable of OECD with a plan to create a premium segment in Russia. The important thing is for this tendency to go ahead, for investors to get at least partial compensation for those deficiencies which are still in the Russian regulation in terms of investor rights protection. I seem to have exhausted my time limit, and I want to thank CFA Institute, the organizers, for the opportunity to speak. Thank you, Oleg. If we can go back one slide. There are three issues: authorities, oil, and bad governance in Russia. But the percentages are quite significant. Could you have your comment on that? I think numbers speak for themselves. The fact that there are macroeconomic risk because of lack of economic diversification is not something new. With regard to government involvement in management of the company and the presence in the economy, these risks are not new. What is new is that investors ranked the priorities the way they did. Creditworthiness is not a big deal, not a big percentage. It's not a big issue, given the investment category of the sovereign debt. Low liquidity is an issue for some companies, Currency exchange risk, same category. It's not that they mentioned this, they are quite intuitive. The interesting piece of information is the ranking, the priorities that were given by investors. Well, price exposure is a major issue. Corporate governance is second, close. And then politics and government control and government presence. Thank you. I want to give the floor to Colin McLean, member of the Board of Governors of CFA Institute.
I am a member of the Board of Governors of CFA Institute, and I'm very pleased to see such a prospering and a flourishing investment community, particularly with a CFA society in Russia, both strong and growing, able to run conferences like this and attracting many more candidates. I think that bodes well for the future of the investment profession in Moscow and in Russia. So I'm very pleased to be invited here. I speak today, though, as an investor, and I'm speaking as a global fund of funds investor, which has had an allocation into Russia, into other private equity funds and into equity funds for more than 15 years. So I'm just going to look a bit at a perspective of an outside investor. I was going to start here with 4 slides. I have just a few slides, but I'm going to start with just 4 slides that are from the survey that Nitin Mehta talked about earlier on that was conducted at the end of last year. I think it is interesting because it gives a perspective on perhaps how investors around the world and perhaps how also Russian professionals differ a bit in their perspective. The survey was of 115,000 investment professionals, about 7,000 respondents, and the error is just about 1%. So it was a very large, meaningful study, and the 4 different elements I think that it highlighted was in relation to lack of trust and the different weightings of elements involved. And in Russia, as you can see here, it's quite low in its focus on lack of ethical culture within financial firms. I should say this is an issue around the world. It's not unique to CE or any of the emerging markets. There's a lack of trust, a lack of support perhaps for financial firms around the world, which I will come to, I think is being addressed by CFA Institute and many of the professionals. But I think here what is interesting is that there was perhaps more focus by the professionals surveyed in Russia on some of the other issues, the poor government regulation and enforcement, and to some extent on market disruptions. In terms of the actions that perhaps might be needed to improve, perhaps the professionals here saw least importance on enforcement, that wasn't the main issue, but some of the other areas and some other nations, I think certainly enforcement of existing laws is a concern, but here much more on improved corporate governance overall and regulation and oversight. In terms of the firm actions that might be taken to improve investor trust and confidence, the Russian surveyed are much more in the mainstream of views here, and I think would align themselves very much with what's seen globally by professionals in terms of what needs to be done to improve. Improved culture, increased adherence to ethical codes, and also clarification of responsibilities. Perhaps in the market here, much less focus on incentives and compensation than perhaps there is in some of the Western markets, but certainly a focus on ethics. And let's move on. And in terms of the ethical issues, again, the survey here highlights Russia as being focused much more on some of the disclosure issues about derivatives and a little bit less perhaps on the integrity of financial reporting, but much more so on some of the other issues. And I think all of these things are interesting because CFA Institute has recognised that after the financial crisis of 2008, there is something of a loss of confidence by investors around the world, and so it doesn't just affect emerging markets or the market here. It's something that is being addressed through a programme that was launched last month, the Future of Finance, which is setting in place a better education for investors, investor rights, and also is spearheading a drive for professionals to demonstrate raised standards and to improve standards across all financial firms globally. So I think the changes here, I think, are not just purely part of governance and CEE, but are very much something that is part of a global pattern of improving trust. And I think the investment professionals really, rather than government organisations or regulators, I think investment professionals themselves really have to be at the heart of that. It has to be driven by the ethics of professionals. And I think the 115,000 investment professionals in CFA Institute are at the core of that. I think as an outside investor, I look for markets with a favourable macroeconomic background, perhaps with some dynamic of privatisation or IPOs, and also for a good stock market infrastructure. And that pattern I see here and in the other CE markets. And I think particularly, the actions of the CE Stock Exchange Group in integrating and improving matters, I think that's certainly very helpful. I think to see the move on to Zestra, the move in here in Moscow on to T+2, all of those standardized systems, I think do help investors a lot. So the implementation of those structural reforms are certainly helpful at the level of exchanges. I think also we've seen the exchanges, the CE group, work much better on some of the other issues that matter for investors. I think bundling of data dissemination is good. And I think also having new products, style indices, very often for investors, they do want to enter markets perhaps with indices or some baskets. So I think the initiatives that have been taken there will bring some new overseas investors in. And I think some of the other actions to improve investor interest as well, conferences and webcasts, seminars, and the participation here by exchanges, I think all help to show to foreign investors what is happening. I think for the further changes perhaps that are holding back some of the investors, we've seen some of those issues highlighted in the survey we were shown from Royal Bank of Scotland. And it's important to remember one of those issues, the sensitivity of the market here to the oil price, is not something that can easily be changed in the short term. But I certainly think there are initiatives in terms of currency stabilisation, central bank independence, targeting of inflation. There are a lot of initiatives there which will gradually change that. And I think the story that we heard this morning about the improving consumer market, and the consumer market, although it's a smaller part of the stock market, consumer sectors have driven a lot of the growth in Russia in particular, and I think that message needs to get out to international investors. I think also in terms of some of the other moves, moving on to Basel III and some of the other initiatives that have been taken, I think will all help to harmonise some of the structures here with what's expected by international investors. But if there's a single thing I think that does actually matter and is within companies' own ability to change, and that's increasing dividends. We've seen quite a bit of increase already the payout ratio going up from what was about 12% when emerging markets in general were overall distributing about 30%. We've seen that increase, but it's increasing dividends and offering dividend yield is one of the ways in which investors can reduce their risk and get more comfortable, particularly in a very low yield environment globally. I think that lower rating that we see particularly on the Russian exchange, the lower price earnings ratio, price to book ratio, I think that a gap can be closed with other markets by increasing a payout ratio, and I think that would attract other investors in. And I think that's one of the pluses for the market, that the rating for the market here is down at the levels of 4 years ago relative to the other BRICS and other major emerging markets. And last time that happened, it was followed by 10 months of performance of stock market gains. So we have a market here that's down, rated at low levels. And I think if there was more marketing to investors of the opportunities beyond the resource sector, I think more explanation of some of the reforms that are being made, and I think a higher dividend payout ratio, I think we'd see that level of international involvement accelerate. The one other issue which did come out on the survey was probably the greatest concern that a lot of the professionals in Russia saw in the short term was Eurozone concerns. And I think some of those are still around, I think particularly with the problems there are in some of the other peripheral European economies. But I'm quite optimistic, and I'm fully invested at present, I should say, globally, and that's because I do think the Eurozone will finally come around to quantitative easing, to printing money in an unsterilised way, which it hasn't fully done yet. I think it's slowly assembling a group of policies which were set out just a week ago by the German Chancellor, and I don't think will be necessarily acted on until after the German election. But I think that the policies in terms of mechanisms for bank resolution for bail-ins across Europe, standardising that, and for a standardised wealth tax arrangement across Europe as well for companies that are bailed out, I think all of these are taking the European and Eurozone resolution onto the next stage. And I think we'll get quantitative easing at that stage, because I think the determination to hold the currency together is what will drive the political will to stimulate, and I think the debate is moving on beyond austerity. So I think for equity investors, I think that Eurozone concern is going to start to ease, and given it has been a particular concern of investors here and the impact on the economy here of the Eurozone, I think that could turn into a positive. So I think there are positives to the market here. There's good structural and stock exchange reform, and I think it's moving in the right direction of travel to attract international investors. Thank you.
Спасибо. Один вопрос Колину. Вот.
I think you have one question for Colin. You said that new indices are a positive thing. New indices are a positive thing. The emergence of new indices at young stock exchanges like Moscow Stock Exchange, what meaning does it have besides being an additional facility for traders? Is there any in-depth meaning behind that?
I don't think this has to be for short-term traders. I think there are many, even retail and private investors in Western markets, I certainly see this in the UK, who now feel much more comfortable in investing globally, often through global fund of funds. And they themselves find it hard to make meaningful allocations to some markets. And certainly for some of the frontier markets, we've seen them do that through indices, particularly if they're stock exchange sponsored, credible, and offer adequate counterparty reassurance. So I think there are many good, sound, long-term investors, not just traders. It's not an issue of derivatives, but an issue of offering a relatively easy and low-cost exposure for funds that already have another layer of charges in terms of fund of funds.
Спасибо. То есть это
Thank you. So this would be an instrument for new emerging markets.
I think it would be good, and we've seen that happen in some of the frontier markets in the Gulf and North Africa. So I think it would be an attractive move, and to move on into style indices and some of the other ways of participating. I think particularly to give some investors maybe very attracted to the CE and to the Russian market in particular, but not necessarily want to add to resource exposure. So I think style indices that offer exposure to these other growing consumer areas would be attractive, telecoms, etc.
спасибо.
Thank you. Thank you. And now I would like to pass the floor to Remy Bryant, Managing Director of MSCI.
Okay, thank you. It's a pleasure to speak at this conference on a topic which is very close to my heart, which is market integration and how essentially investors around the globe can invest in various markets. MSCI has been for many, many years looking at these types of issues, and we on a very regular basis talk to regulators, stock exchange, and market participant on these topics. I was in China last week, where there's a number of relatively important regulatory changes in one of the last few markets that are still close to international investors. So it is a very dynamic area. And what I would like to do today is to share a few views on trends that affect international investors and how those trends can and will shape also within the dynamics of the markets in the Eastern Europe region. If we look at the aspects that has been driving a lot of investment flows over the last 20 years, globalization has been one of these important strengths, which really translate into first economic growth, which then translate into more investments in the various, in this case, emerging markets, and that translate then into generally bigger markets, bigger capital markets, which is really a combination of price appreciation, but also the opportunity set available to investors growing regularly over the years. If we look at the way we've been capturing this effect inside our indices, we've been doing that for 40 years now. You can see that a few years back, it was mostly an element of adding markets which are now considered as developed markets. Then there's been another trend, very regular in the 90s, of adding countries to the indices as those countries were opening up, and that was including a number of Eastern European markets, which we included as liberalization and market opening happened. And then there's been a third wave of additions, which were more in the category of frontier markets, so markets that are less easy to access, but are nonetheless investable by investors. And the effect of those opening, the effect of market liberalization, the effect of a number of structural changes that were done by the various market participants, regulators, and stock exchange to essentially make the markets more compatible, make them more robust for investment. That has an effect on what we would define the available opportunity set of investors. And why is it important to look at it from this standpoint? If you look at how some of the very, very large investors around the world are investing today or making asset allocation decisions, they very often rely on a definition of the opportunity set, which is an index or in the case of policy allocation, they call it a benchmark. And this benchmark essentially set what is available. What is outside the benchmark tends to be forbidden to invest or becomes a more risky investments. And as a consequence, adding market segments is effectively or including an additional country in an index is essentially a movement that allow those investors internationally to invest in the market. This is a phenomenon which has essentially increased in speed over the last 5 to 6 years because it combines effectively more countries being open with another phenomenon where international investors are moving away from what we call a home bias, which is more investment in their own country than would be the natural weight of the country in the global universe. And if you look at investors like Norges Bank, which was appearing as one of the largest investors in one of the previous slides, in Russia, Norges Bank, which is a very transparent and very large investors, has made a very public decision to actually increase their allocation to emerging markets. So it is a trend that continues and actually accelerates. And it is also linked, if you want, to a change not only of the opportunity set, but also a reflection of the economic structure of companies. If we look at the problem from a slightly different angle and look at not only where the companies are listed. So if you look at companies in Russia, listed in Russia, if you look through at their revenues, or if you look at the companies listed in the UK and where they're making their revenue, what you can see is that there is a disconnect between the definition, I'm listed in a country, and the actual economic exposure of those companies. And there's been a phenomenon of globalization for those companies. So in this chart, we're showing what is the weight, for example, of the US in a market capitalization index. It's very high. It's almost 50% of the universe. But if you look through at the revenues of the companies listed, they have actually a relatively large exposure to emerging markets. And effectively, the economic weight of emerging markets in the global listed universe is much higher than the market cap weighting. So investors are also interested in not only restricting a little bit artificially to their own markets, but essentially getting an exposure to the global economy, and that is leading to a decision to invest globally rather than in their home markets. That is what we see happening gradually. People going from being 100% domestic to being partially domestic, partially global. And if you look at the most sophisticated investors globally, they tend to use the MSCI ACWI IMI, which means for all country investable market index, an index of 9,000 securities globally, spanning large, mid, and small cap, as well as developed and emerging markets, as their reference point for their equity allocation, which is really a reflection of the global opportunity set. So why does it matter for investors that may be sitting in a high growth economy rather than sitting in a developed market, maybe less growth economy? We've looked at this issue because you could argue that if you sit in a country which is growing very rapidly, maybe you don't want to invest globally. Maybe you want to put all your eggs in one basket, which is your own basket. And so we've looked at we've done a relatively extensive analysis of emerging markets over the last 20 years, and we compared essentially a series of investment decisions, either investing fully in your own market if you're a high growth country, and we've looked at all the economies that were higher than the global average on a sustainable basis, and compare that investment decision, everything in your own country, with alternatives which would either put 25% in global markets, 75 domestic, and in increasing number up to 100% in a global allocation. And this general statement, which we've been arguing for quite some time, which is the starting point of your equity allocation should be a global one. That is also true from an emerging market investors. If you look at the portfolio, which would have some global allocation, it is less risky, up to 30 to 35% less risk in the index. And as a consequence, the return, the optimal portfolio, which is the return per unit of risk in your portfolio, is generally higher as well for those non-domestic allocations. So we do see, if you want, an argument to go global from also the standpoint of an investors in an emerging market index, an emerging market country, sorry. The other arguments which we've been hearing and discussing quite a lot with sovereign wealth funds around the world is the argument about the allocation to global markets from the standpoint of managing a crisis. If you look at, obviously, the various types of investors have different objectives, but very often sovereign wealth funds are investing for the very long term, and but can also play a role of market stabilization, or have been given a mandate to play that role in times of crisis. And if you compare an allocation from a sovereign wealth fund, which would be 100% domestic, and compare that allocation with one which would be partially global, when crises come, and they do come on a regular basis in every country, developed or emerging, it can make a big difference. So we've illustrated that by looking at the effect of the 1998 crisis. We've picked a country that was affected by that crisis, and look at the choices that sovereign wealth funds would have had at that point in time, should they wanted to raise cash during that period. You can see that if you essentially need to have cash, or you want to stabilize the market, if all your investments are domestically, you're selling at the worst moment, you actually amplify the crisis, versus if you have an international allocation, you can actually sell and buy back domestically, which has a counter-cyclical component. So if we summarize a little bit this phenomenon, we can see that there has been and we think will continue to be flows going both sides, both international investors continuing to invest in emerging market in particular with increasing speed, and in parallel, emerging market investors through their various funds, either retail funds or sovereign wealth funds, also starting to diversify from a very highly biased allocation domestically to one which would be much more global. Thank you.
Спасибо.
Thank you. So we have taken care of all gentlemen. Now we give the floor to Jana Michalikova of AKAT.
I'm not sure whether I have a presentation. Yes, I do. Извините, но я говорю по-русски еще плохо.
I'm sorry, my Russian is not so good, so I'm going to speak English.
Association of leading investment management companies, banks, and exactly as our colleagues, we tried to define some goals or some ways how to improve the market in order for the biggest benefit of investors, even of asset managers. In my presentation, you will see the size of the market, the top participants to the market, some historical numbers, and I would say that just numbers and graphs. You will see it later. And we have tried to define some trends in the asset management industry. As to asset managers, we must definitely see the consolidation of asset managers or of funds. It really means that to lower down the costs of management of funds and then to be as much flexible as possible in order to provide more solutions for investors. As to retail investors, I would say that this is the case of all the Central Europe. It means the decreased popularity of money market funds, increase in popularity of bond funds. In Czech Republic, there's a small specialty that we see an increase in direct investments into equity by retail investors was pretty interesting because our investors formerly were extremely conservative and I would say that more than 60 or 70% of the market of funds, it was just money market funds, and now we see really strong increase in direct investments. Then our investors, retail investors, they focus on long-term investments. It means like the protection of the value of their investments or something like savings for pensions, what actually really good for funds but for investors too, of course. And they really try to diversify their portfolio. What's extremely interesting is the qualified investors, because this sector is extremely growing in Czech Republic. And what do they require is progressive strategies. It's, I would say, even the hedge funds are being managed and promoted in Czech Republic. And what they really require is the separation of management and administrative functions, what actually means that it's the investor who needs a support of manager, the support via the administration of funds, what actually means valuation, some reporting to our regulator, but what he actually really requires is that the portfolio management or the decision on investments is being done by himself. Here you may see, again, this is the one graph I will comment on, and you may see that even during the crisis, there was a stable growth of qualified investors' funds. What's really, again, very interesting, because as in any other types of assets, you may have seen some decrease. In here, there is a stable growth, and the numbers have grown enormously in the past 5 years, 4 or 5 years. And this is what actually we do. We just have seen some trends in the behavior of investors as retail and then qualified investors, and we have seen some trends which asset managers require, and this is exactly what we do. We have very proactive and very business-oriented regulator. Our Ministry of Finance is in favor of the fund sector or asset management sector, and they are doing their best in order to provide us with very good legislation. And the result is the new act, where we have forms standard as in Luxembourg or Malta, what actually means SICAVs. Then we will have also SICARs and other types of legal forms for funds. And this is just the details as to SICAVs. And then other things which are happening in our jurisdiction, in our country, and it is the administration of funds, which is becoming very popular. And I may say that there has been also a shift of some funds from Slovak Republic into Czech Republic, whereas the portfolio management has been set by the Slovak company. However, the administration was shifted from Slovakia to Czech Republic. As to alternative funds, we are now launching the seed fund, which is actually a venture capital fund, and the money comes from the European Union, and this is in order to promote new companies. Then we try to lower down the administrative burden for funds, and this is the result of the new act, which will provide us with lower administration. The Czech National Bank is, I would say, very clever regulator or very clever supervisory body, and they really differ between different types of funds. The typical example is the qualified investors and retail investors. And of course, we deal a lot with top issues, which are mainly the taxation issues. And Czech Republic is one of the countries where no FTT will be applied, at least within our country, because we all know that FTT shall be applied on both sides. So this was my presentation. Do you have any questions? No, so thank you.
Спасибо, Яна.
Thank you, Jana. Now it's time to draw some conclusions. I asked Konstantin Koreshenko, professor and head of the department at the Academy of Economy. I hope that this will be interesting. Thank you. The subject of the conference, regional consolidation, if I may put it that way, covers two sides. There's an external view on the state of markets, and there's a domestic view on the state of market in Russia. So the first question that comes to my mind is whether or not it is possible to have regional and local markets in today's situation. My colleague from MSCI has shown that today most investors, the majority of investors, invest globally, and local attractiveness, if I may put it this way, local carrots, they certainly may be there, but any good idea in terms of raising attractiveness of a specific market is immediately replicated in other markets. So such advantage does not remain unique for any considerable period of time. So today we need to see what the main trends are, what helps create local and regional markets. In one of the presentations, there was a statement about the World Federation of Exchanges and its conflict with our organizations. You may remember the history of MISEX and RTS, and RTS's paradigm was similar to that of the World Federation of Exchanges. That is, they wanted to build everything on their own without resorting to the help from regulators. The other position was that it was important to come to terms with regulators and use their support in integrated markets. We know what the result of this is. There's a certain contradiction between positions, and today it is still a motive force. Market competition faces strict regulation in all spheres. Look at the initiative and practical steps in taxing financial transactions,
which is going to affect the development of the market. So one of the surveys has shown that the integrity and ethics of financial companies enjoy least trust, and that of course reflects the impact of the 2008 crisis. And again, this has to be taken into account by politicians building a regulation of the financial market based on how their voters view financial institutions. And a good case showing that politics and finance are intertwined is the unfinished Cyprus story, where financial economic decisions were very much politically motivated. And I think it was more or less the same with Greece. But there was more of financial economic logic about Greece. With regard to Cyprus, there's more politics and political logic. In summary, what I've just said, summarizing what I've said, today's development of the financial market is much more subject to political influence compared to 15 to 20 years ago, although at that time specific governments and the world community were influencing financial market, at the same time providing more scope and freedom. Now their view is that you are not coping, so we should help you through tight measures and policy. Before going to those who know the statistics and those who have been familiar with the subject understand that speaking about the CIS regional market is a too optimistic view. If you look at the statistics, in terms of capitalization, Russia is 20 times larger. With regard to turnover, CIS accounts for a single percentage point. The changes we see in the regulation and legislative framework in Kazakhstan will reduce this market. I think the hope for a regional market here is a too optimistic a hope. A regional market is based on Russia and with countries surrounding Russia may be to various extents involved. That Ukrainian company is traded at Warsaw Stock Exchange and is an exception, proving the rules whether there is a prospect for integration of the markets. There was an idea expressed here about what this integration is going to happen around. IT is an important thing, but it's not key. What we see in Russia and elsewhere, even earlier elsewhere, as to how quickly 3 layers of these stock financial markets are developing. First, it's the trading layer, exchange layer, other trading systems. The second layer is clearing entities. And the third layer is settlements, security settlements, and covering now derivatives. The merger of exchanges story is a thing of the past in a sense. Today, the driver for the development of the financial infrastructure and financial markets is the core part, the clearing entities, central counterparties, and how these entities are regulated in various countries and how quickly they can develop. And to what extent various markets can perform the role of the centers of consolidation. The United States are ahead of everybody else. In the 1970s, they created DTCC eventually, and then consolidated the infrastructure in Chicago. And now they have a pretty well consolidated infrastructure for clearing and central counterparty operation. In this area, Europe is following its own path, a gradualist path, which so far did not gain any victory or overtook these US rival competitor. In Russia, we've seen consolidation, but not supported by protection measures. There have been many comparisons. Russia was compared with BRIC pack. There was a chart shown, Russia lagging behind in terms of index and index's behavior. One thing to be borne in mind, all the countries which are part of this, except Russia, have currency regulation, and some of them have very tight currency regulation. And direct comparison of financial mechanisms does not prove that currency liberalization promotes market development, but rather proves the idea that a currency liberalization makes a country subject and prone to external shocks compared to countries that create and maintain this protective system for some time. Today we are competing directly with external markets. And it's hard to win in this face-to-face competition. And support for the regional, national market protectionist measures are measures that will enable the country to preserve the domestic market. And the tendencies that we see now do not show us good prospects for good. Big turnover in Russia. Why? Foreign exchange, money markets, involved in refinancing, debt refinancing. Thanks God we managed to maintain a small government debt. At the same time, some big corporate debt level, which are visible drivers for market growth. In other countries we see more or less same. We see what's happening to debt across the world, and most likely where debt is traded, this will be the centers of the activity of the financial market. The second element, despite the explosive growth, is the derivatives market. Now we see a tighter regulation of this market, and the fall of the gold price and drop in the gold price is linked to the idea that the central market of Cyprus will be selling its gold reserves. But don't forget that at the same time, a pretty tight regulation was introduced limiting the positions taken in derivatives in commodities markets in the United States. And the impact of that regulation was a bigger impact on commodities market than a sale of some small amount of gold in Cyprus. The prospects for derivatives market are quite significant, but they will be facing more and more tightened regulation. and it's not obvious that they will become centers of consolidation. What is going to become a center of consolidation is ETF and ETP markets development. They are actively produced, offered for sale, and being a Russian investor, and I'm a client of two banks. One of them is foreign participation, the other is purely Russian. And despite a diversified approach to my portfolio, I have never given a proposal other than ETF. And there were reasonable offers, and since it was lacking in the Russian market, one should realize that many were given these offers and proposals. And the minds of investors is turning their heads to this instrument which is lacking in the Russian market so far. Other comments, not necessarily in a systemic nature, about the situation and status. In Russia today, there's a decision on establishing a mega regulator. In my view, it's a reasonable and useful decision which reflects a more serious tendency which is to save on transaction costs. When businesses begin to save on costs, that shows that super profits time is over. And one has to fight for maintaining profitability, which is done by reducing costs, which means that Russia has this division into developed and emerging economies. We're de facto are living within an infrastructure of a developed market, and to hope that there will be a repetition of the 90s or mid-2000s is too optimistic. And one should be very selective. And with a large measure of government support and other kinds of support for the market and market participants to grow and develop those instruments that will be traded in the Russian market. And one more comment on how development is occurring and how it is gradually changing the market. One of the slides showed a chart on how the situation changed after the central depository law was adopted. There was one chart, a simpler chart. The second chart is even simpler than is shown on that slide. There was a local custodian shown there, which is extinct now. And external investors got almost direct access to the Russian central depository. The answer is open. Whether it will lead to a situation where through simplified access the activity in the domestic market will grow, or it will lead to another situation. By getting simpler access to Russian assets, it will be easier to move them to external markets, and then maintenance of the domestic market will become problematic. The coming 3 to 4 years will provide answers to those questions. And by answering this question, I will finish my presentation. We're a little bit behind the schedule. If someone has questions, please ask them quickly. I have one question to Mr. Karishchenko. On the one hand, you provide good news. I wrote a column today, today's paper, published in today's paper. Without derivatives, there will be no development of the market. In what sense this regulatory hurdles impede. Derivatives is more interesting. The debt market is slow. Actually, the approach to derivatives issue in the Russian legislation has been done many times. There have been many attempts. I've seen 2 drafts at least. The law on derivatives, or close to it. It would appear to me that evolutionary development will not work. We don't have time to gradually develop the market. We are in a very stiff comparative environment and have to make decisions quickly. The law on derivative is so comprehensive that I cannot imagine it's a law on standard contracts. I doubt that this can be adopted, given the fact our legislative process works. I think it's a matter of possible liberalization and according the rights to domestic institutions to issue some contracts that will be traded and will be developing by themselves. And unfortunately, our legislative system is not right for that. Up until all the details are described in the law, and up until there are bylaws issued, several dozen of them, it doesn't work. And this affects everything, including derivatives market. Dear colleagues, we run out of time. That's time for the next session. If you have questions to the panelists, ask them during the coffee break. Thank you very much.